When I got finally my PhD, it was 4 years ago, exactly in September 2021, I wrote on my LinkedIn that one day I wish to see entrepreneurs, C-crews, board members, and regulators working together, crafting principles that are translatable into real and simple practices. And guess what happened? Last year, exactly 3 years after this wish, Bank of Lithuania stepped really bold step and asked the question that maybe we can develop risk management guidelines together with fintech companies, with Fintech Association, and external experts. And even more, we stepped asking, what if each fintech develops a risk management framework in line with their business growth and ambition? Key argument behind this bold step to involve fintech companies to develop risk management guidelines was actually challenge how to differentiate requirements. Fintech companies, they are so different. I will show you a little bit. And it was really challenging that one size does not fit all. And then it is very much important to somehow adapt and adjust all those requirements. Yes, Bank of Lithuania stepped this bold step, initiated the project. I became a project manager and then lead and this external expert. And I first started to ask that, okay, so why we have this situation that we need to develop the guideline and what is behind, what is the fintech company as such? Because if we want to build resilience, if we want to have this conscious self-regulation or at least practical real risk practice in companies, we have to understand internal and external context. So there are like 3 parts, but the regulator usually sees just one of it. Fintech. And it is regulated not under tech. Now DORA is coming and then enforce, so it is a little bit about tech also, but basically it is financial services, and regulator looks to fintech companies from the same lenses as they are looking to the banks. And there is the reason why involvement and the dialogue was needed. And of course, there is customer. Fintech companies, contrary to banks, they are very dynamic. They expect it to be simple, friendly services, and nobody wants to experience those long-lasting, slow, and complicated procedures as banks are applying on us, customers. I don't know. I want to emphasize that without regulators' initiative to have around the table companies, experts, association, this real change in regulation is not possible, unfortunately. Yeah, but let's look at how things unfolded. So as I said, the fintech companies are very different in size, and here it is print screen in Lithuanian because I was not able to find it in English, but it doesn't matter. Like last year, official statistics that we had over 100 financial companies working in the sector. It is only about payment part. There is no crypto yet maybe this regulation will cover also crypto companies, but it was about payment companies and electronic money institutions. So we had operating companies over 100, and you see some numbers. 3 billion euro client funds are safeguarded in sector. Over the year, it was 80 million operations in total, and 151 billion euro total amount of payments, like a total sum of payments. So you see that, like, it is significant part of industry, but big companies, like influential companies, with significant influence, only 30 companies represent over 90% of the market. So you can guess that there are like a tiny niche players with boutique services, fast growing, etc., etc. So a lot of variety. And together with Lithuanian Bank, when we were crafting this project, we decided that we have to invite very different companies to represent different segments of the industry. And 6 volunteering companies were selected, and we started. It was quite interesting to look to fintech companies from the startup perspective. And we relied on Danish fintech sector's analysis and looked what is happening. So the life cycle of fintech companies is quite short. On the median time from initial capital financing to IPO, it is over a little bit 6 years. And only 15% of fintech companies reach this IPO stage. On their way, they either merge together or silently leave the market. Or sometimes maybe not that silently. It is worldwide statistics, but we looked what are success factors, and we identified based on the study that there are like 4 key pillars that are equally important through a whole life cycle of fintech company. This is like a customer centricity. We cannot allow ourselves to lose the connection with the customer. Ease of compliance. This was the next one, that it is very much important. Team, of course, and internal communication. And remember this question: what if company could develop the framework according their business growth speed and ambition? So we decided to build around the life cycle of fintech company all this regulation. All the information is on officially present on LBLT site, and you can find yourself. So I will not go into details, but from the very beginning, we clearly aligned on the purpose. What is the purpose? And everyone, regulator, association, fintech companies, they have the same purpose: strong, prospering fintech ecosystem in Lithuania. Because nobody wants to be part of weak, not performing industry. And then we identified like 4 key things that we should agree. So it is very important to have as much as needed clarity how business and strategy can be integrated. Then this management system itself, what sources we have, what controls are best practice based. what is natural rhythm of organization and how all those practices can represent and cover risk and business together. And finally, of course, roles and responsibilities and risk culture. And the first phase of the project was to go and look at the best practices. Lietuvos bankas had this requirement that all this guideline should be based on real practice that is present now in the industry. And I started with those questions, and for me, it is really, how to say, I mean, I really enjoy being here with you and talking to you. Of course, I would love to have it more interactive conversation, but nevertheless, because compliance people were contributing very much to development of this new guideline, which was the unique case in the market when companies itself, they open their own kitchen and they show their best practices, and based on those practices, the guideline, the requirements are developed. So this is what absolutely innovative step, and I'm really proud to be part of it. So we started to ask, what is current practice? What is working? What is not working? Where are you just pretending? How you run your business? How you manage to achieve your results? And where you feel that you are struggling? What real risks are left behind the risk map? I asked this question also meeting compliance people, meeting CROs, and meeting sometimes founders, sometimes CEOs of the companies. And, you know, the most amazing part of the project was that business part, like CEOs, board members, they also contributed a lot. They showed a lot of interest to this field. This myth that risk management is needed only for compliance purposes and regulatory requirements, it is already vanished. I mean, people really care about real risk management. And of course, we discussed how we can navigate between customer needs and regulations. So I got a lot of information. I systemized this. I looked to documents. I interviewed people. I even collected evidence of real practice behind, asking like, could you show me? Could you show me your agenda? Could you show me how you do this? Where it is written? Maybe you have some dashboard. Maybe you have some regular meetings. And who is present, how often it happens. And to know what happened, like behind the scenes, participants of the project, they discovered that they are doing a lot already, a lot about risk, and quite a significant part of those things are not classified as risk management practices. So it was really interesting, and I think that this is a message also to you, that not only dedicated documents or dedicated practices are part of risk management framework, especially when it comes to compliance. And sometimes it is important to step from our this straightforward habit to translate regulatory requirements to new procedures or new requirements within the company. But it is, but when we look around and ask us, maybe we're already doing this. Maybe this is not regular. Maybe it is not visible. Maybe it is not written. But maybe we're already doing this. And if we found evidence that we're already doing this, it is much easier to level up, to systemize it, to standardize it, and to make it visible. Okay, so what emerged from this project? I shall confess that at very beginning, when I stepped to this project, the request was based on best practices, to collect best practices, and based on this, to deliver recommendations how to improve the risk management guideline. But I had no clue that it could emerge to risk maturity model based on fintech life cycle. And you know what? I'm really proud of our regulator that in English version, in documentation, in official version of guideline, you can see this rocket phase and this baby born phase. The names are left as they were created during our working sessions within the project. The life cycle of a company starts from the licensing. Then it starts to grow and scale up and rocket. And of course, in each stage, the relationship with risk and risk exposures and even competence are very much different. And resources are also different that company can allocate and employ as risk management tools. And the best part is that risk management system can evolve in line with the business growth. And, you know, it is quite simple, like, okay, I'm not fast. I will stay in this grow up phase and then go vertically within my initial license for a couple of years, and it's fine. I do not need advanced risk management things in my company. But if I know that we have very high ambition, we have funding, and we want to expand very fast, then of course I should pay much more attention and to build the framework that supports this business growth. Risk management should not go behind the business. Risk management should go hand in hand with business and serve as business enabler to the companies. So shortly, like in this baby born, the most important is to build competence, to access to funding, and of course, risk management happens usually ad hoc. As team is small, they are sharing information very fast, and all they need to ensure that they comply with key requirements to keep license operating. When they start growing, the focus already is a little bit shifted on efficiency and positive cash flow generation, because sooner or later, each investor is requiring that, okay, guys, you should show profitability and then optimize operations for scalability, because it's not the end. We're just starting. And in scale-up phase, what is the difference between grow-up and scale-up? In scale-up is when they kind of growing horizontally, entering new markets, choosing new segments of customers, or maybe introducing new services and extending their license. So in scale-up phase, of course, complexity increases, team growth, and automation is vital already. It's stepping in, and the team is bigger. But the tricky thing is that the most job is done by risk manager building the framework and involving the company in growth phase to prepare for scaling up. And here sometimes regulatory view, I mean, is a little bit different, but we know that it is important to do job before the move. And finally, when the company enters rocket phase, has the significant presence in the market, they keep innovating, they keep growing, but they already dictating those best practices for the market themselves. And job is done. We have a strong team, we have a system, we have a lot of automated controls, and job is done. Everyone knows already what is risk and can make decisions in uncentralized manner. How does it look in reality? The company can understand, can check where we are now. Where we are now. If we are in growing up phase, so there are like a lot of very clearly defined, it's not requirements, it is guideline, it's not obligatory, but like practices and views, what should be in one or another phase. And the company can identify where we are now. Okay, if we are grow up and we have like certain points very strong and exactly aligned with our current life stage, but there are some places that we are behind and we are not that fast. And it is important like to talk about this right now, because this new guideline is stepping in force since January 2026. So companies can plan how they close the gaps, or maybe some risks they admit, and then they are prepared to manage the outcome if they face a risk event, but they can plan how they close the gaps and how they prepare for the next move. So with this clarity, what are key considerations, how risk management framework, competence, roles, even mindset are developing through the cycle, it is easy to plan. It is easy to plan. It is easy to understand where we are now. And with this view, with this approach, we can really have the self-assessment and have dialogue within the company, why we need one or another thing and how it can help us to enable our business moving forward. Of course, this dialogue is not usual, and it is big shift and big challenge for both, for regulator and for the companies, to have a dialogue and to adjust and negotiate this development of the system itself. But this is the key possibility that is opened with new regulatory guideline. And I think I'm believer, I might be naive, but I'm believer that this is a foundation to step towards self-regulation in fintech sector. Okay, so basically, this is not that important what is written in our documentation. I mean, this is important. We should make it visible, and it is easier to communicate when we have clearly standardized things. But the most important is what we know and what we do, and what we do not know about risk. So how to make this visible? If I'm criticizing this risk management instructions, so how make it visible? The key thing is that there are a lot of discussions in global market about risk registers and risk maps, heat maps, that they are dead, that they are not servicing business purposes, that they do not providing information for decision making. Of course, if they are developed only as reporting things once per quarter, they are not creating value for the company. But if they service as a structured form to see things in one place, I mean, it could be a good transition. But the key thing is that response, like those controls, mitigation plans, they should become tasks, visible, accountable, and if they enter into our Jiras, into our planners, into our whatever tools do you use for planning and then accountability within the team. If they are visible, we can convert those risk registers to tasks and to have it up and running and then visible. This is the most important. The second part is when we set the risk appetite and limits, and it is also presented in this new guideline. We grasp that we should make it visible again. So if we have just statement on risk appetite, well, it is better than nothing, but it is not enough. We should have it visible. We should be able to see in our dashboards and to monitor business and risk together. So those also best practices were already discovered. They are present in the sector, and they found their way in this new guideline. And to summarize, how to prove that something is done with risk, and I believe that looking from compliance perspective, it is very much important to have this proof, to have this visibility of things, because it's not enough that Vilma told me that she's doing something. Yeah. There are like three key things, and we cannot choose just one. Documentary compliance, meaning that it is written, we can show how it is present. As I said, agendas, tasks, dashboards with their like a dynamic rhythm of how we renew this information, our decision-making bodies, our accountability and traceability, and finally, business indicators. And even when I asked the Bank of Lithuania, okay, guys, I said, when you're coming to inspect the payment institutions and you are looking how they are managing risk, what do you look at? Are you limiting yourself only to documents, or what are you doing? So they said, well, first of all, we have indicators that we are following and how we are monitoring. They have their own vigilance. Yeah. So some of indicators are publicly available of the whole sector. So we have like a business indicators and risk indicators. Then, of course, this is documentary compliance. And the most mysterious part is this real practice, how to show that things are happening. So I already made some hints for you how to see. But the best question is simple to ask colleagues, could you show me how you do this? Where can I see that it is happening regularly? And Bank of Lithuania is also using those questions, and they even said that, yeah, sometimes it is a funny situation when documentation is perfect. It's perfect. Indicators are, not that good. So the question, could you guys show me how you do this, or all those practices that you have in your documentation? And company suddenly asked that, oh, well, could you give us 2 weeks to show you? So if I'm doing, I can show you immediately like this, sharing my screen or like taking by hand. I said, okay, look, in our kitchen, there's monitor where our key indicators are running and everyone is informed, or maybe our team is gathering each week and we talk about key risks and about key achievements and key challenges of business. And it is already artifacts of real practice. And for visibility and the standardization principles, in this new guideline is part about rhythm of organization. Not going into details, but again, if we want to grow habits, if we want to embed this holistic mindset that everyone is part of risk management, it is important to connect, to really integrate like strategy planning with, for example, EVRA. I know that EVRA now is servicing basically for AML purposes, but I see a lot of importance in this instrument. Risk strategy review should go hand in hand with budgeting. System review and improvement also should be connected with business planning and then looking forward, because how we can plan our risk management system development, not knowing how fast we are going to grow our business. I mean, it is ridiculous. And we can do this also in very nice way, like a systemizing and looking, okay, so if we have this yearly cycle, how we should follow up, how we should ensure accountability, how frequently we should share information, we should discuss, we should learn, because it's not enough to have nice dashboards or like a lot of data available in systems, but we should make sure that we looking at this data, we understand it the same way. It's our interpretation about our current situation, and even more important, how we use this data in our decision making. My advice is how to make this practical, to start a little bit like classify what we're doing with risk, what we're doing with business, and trying to connect the frequencies to synchronize those actions and to look, okay, so we are doing this ad hoc, but in reality it happens each week. Why we cannot turn to it to weekly exercise with blocked time for this each Tuesday, for example. So, and you do not need to write those piles of documents. This one pager is enough for organization to understand where we can post our question and where we can get answer, and how we are organized and synchronized together. Yeah, and then kind of like going basically to the end with this presentation. What my learning from all my practice with risk, where this scientific research and this beautiful project that I'm really proud of, that it proved that risk is at the same time real and socially constructed.